someone joins late, but I know probably someone doesn't know where is the chat part. Chat. So I just shared the link for the files I'm gonna use. Today we're covering financial mathematics second part. So it's continuation from last week. Last week we started class 2 file. So you can download class 2 file, and class 3 we're going to move to the class 3 as well. I mentioned last week the best way actually is if you have a 2-screen or it's a split screen and you look at my screen, but also you have your own Excel file, and then you can follow. Try some of the formulas in there and check, and even though you can't follow every single formulas in the Excel file, but but that's just watching is not going to be really helpful, because you're not going to be able to do everything after the seminar on your own. So try to follow as much as possible, but there will be some parts you're going to have to review with some more time after the class and then seminar. So if you got the file, I'm going to share my my file today. Share screen. All right, so if anybody does not see my Excel file, just please let me know. So in the class file 2, we covered compounding and how to model a bond, rule of 72, and log scale. So today we're going to start from the life annuity part. So just for your information, and top part of the Excel sheet, there's a link. Is the video files, so short video clips are linked to here, and then another instructor recorded the content. So it's a different way of actually learning about this assignment. This is an actually assignment from the class. So if you are taking a class, actually you're supposed to do this one in a group. So the question here is, a life annuity is a financial product that you buy from a life insurance company. It pays you a fixed amount of money. There's a typo here, amount of money, for as long as you live, $50,000 here. This, let's say, is annually. And this protects you from outliving your money. So this is hypothetical, but there is a life annuity in product like this. Of course, the insurance company needs to make money, so they will price this financial product accordingly. To find the value of the annuity, the insurance company considers your probability of survival. In traditional discounted cash flow valuation, and there is no probability of survival. So this life annuity case is applied discounted cash flow valuation. If you're not sure, if you haven't heard, the discount cash flow valuation is to estimate the current value of a certain company or a financial product, and usually stock or a bond, you discount all the future cash flow amount into the present value and using certain discount factor. So that is the discounted cash flow valuation. This is one of the valuation techniques in the corporate finance. So life annuity, the value of life annuity, first of all, the annuity has the recurring amount of cash flow, the same amount, in this case, $50,000. For your perspective, this is gonna be the positive cash flow, so cash inflow, because you're receiving. And then you're gonna have to pay to purchase that product. And then from the insurance company's view, right, what should be the price? That's the price you are gonna pay insurance company. Insurance company want to calculate the value of this cash flow amount. Like if they pay whoever purchased the insurance, this product, the life annuity, right? There are multiple things and the insurance company assume. So we'll see how setup is done in the next tab. But the questions we have here, we'll actually come back to this question after looking at how the setup is done, because your file has this setup. I just changed the color of certain numbers, red and blue, to show you which one has a formula or which one is important here. First of all, again, there is a video clip if you want to watch after this seminar. It's going to be helpful for you. P of S. So S here stands for the survival. So this is a probability of survival, but it's not just at a certain point in time. It's a probability of survival up to the time t. In our case, we're going to consider this time regards to the age. Starting from age 81 in our setup. It goes to all the way the 105 years old. Yeah. And then in order to survive until a certain age, right? This is, you should have survived before that. So it considers up to certain age. Next one, P of D shows probability of dying at time t. So in each year, right, at a certain age, there is a certain probability. So let's go actually one by one from here. Survival, yeah. So in this line, P of S, the survival, is first year, you set up age starting from age 81, and then we call it as year one. And time-wise, we're calculating that time t equals 0. Then what's the value? That's our end goal. This 15% of probability of dying at age 81 is given to us, is 15%. So if you let's say if you work in a life annuity insurance company, it's estimating this one is not going to be a trivial task. But in our example, this is given to us. So our case is calculation example. So, but just think about that one, how to estimate this one, and that's not easy. And then also in our setup, 81 means, we current age is actually 80, and then in 1 year you're gonna get paid for the first time. And probably a survival in the first year is naturally, yeah, if you do not die, you survived in that year. So 1 minus 15% is 85%. But the second year, if you see, the probability of death and dying in age 82 is 1% higher than the prior year. So as you get older, we assume the probability of dying in that age is actually higher. So we increase this percentage by 1% every year. But probability of survival in the second year is not just 1 minus the 16%, right? Unlike the first year. Because you need to survive in the first year, you gotta multiply by the survival percentage from the first year. So 85% is multiplied by 1 minus 16%. So as you can imagine, next year will be the same, right? The prior year's survival percentage, which is 71%, needs to be multiplied by 1 minus 17%, which is probability of the dying at age 83. So probability of dying keeps increasing by 1%, and then probably survival becoming conditional, including the prior year's survival. Now, discount rate, R represent the discount rate we give here, because we're going to use a fixed discount rate of 5% for simplicity. And then we also give the name for this one. We treat this, even though this is just a single number, we can use this one, by giving a name, R sub bar, is our underscore. So instead of typing 5% or pointing to cell, we can use the just name, like treating this one as a data array. So R underscore. And C represent a promised payment amount, which is given to us in this case $50,000. Is that actually right amount? How to estimate actually that amount could be a different question, but in this case, the product is giving $50,000, and then how much the present value that those all the cash flows will be, that's our goal here. So we're gonna put this $50,000 in this row in every year, and then using this entire row, right? If you select this, if you select this, you can see this array, data array, also has a name, capital C underscore. So now we have all the setup from age 81 to 105. And this line, actually, I did not explain what this is. The goal, the first goal we need to calculate. What are we doing to calculate the present value here? Present value, we are using this row T because that's the first year. At age 81 is first year. In order to discount that to the present year, like age 80, right? We're going to use this time T to discount. So what are we doing here? This is a present value factor. So 1 plus R underscore, which is a discount rate, to the power of negative year, number of years. So this is basically, we are the same as we are actually dividing by the factor. So that's rows. So discount factor like this. In order to calculate a present value, we got to multiply this factor to the value. So this is a present value factor, but we are using this entire row by using a name so that we don't have to change this formula in all the cells. It will apply to each column, right, accordingly, because that's what this dot, the @ sign in front of the T actually shows. So this is all the present value factor. Now that multiplied by the cash flow amount. But that's not it. If you see the present value of cash flow, excuse me, PVCF.
I know that.
There is one more factor considered here, probability of survival. So this is a difference from the traditional discounted cash flow technique. If you just multiply $50,000 by this present value factor, it gives a present value in dollar amount, but you also need to consider if this person actually survived for the year and then actually received it. If this person did not survive, that cash flow will stop. The insurance company will not pay for the deceased person. That's what the policy actually is. Just has a written contract about that. So another factor, probability of survival, needs to be multiplied by that, by the whole amount. So it's $40,000 right here is the present value considering the survival. It keeps decreasing the value because in addition to the actual present value, you multiply by probability of survival. So it's decreasing very fast. So total value for this life annuity is you adding all of this present value. Yeah, if you add all of these, it actually becomes this. Oh. Yeah, this one. So sum of PVCF, we gave name to this array as well. You can do manually select the cell range, but in this way it's easier to understand, right? But Excel, you got to think about it, what cells are actually selected. But this is the value of the life annuity product. But probably this could be the minimum price the company can set. Now we understand the setup. Now back to the question. Actually, question, you're supposed to answer 3 questions based on this one. What is the impact of raising the discount rate by 1%? Which means this 5% becomes 6%. So this is very easy. You change this to the 6%, and then everything will be changed because present value factor will be changed, and then this present value will be changed. So sum will be changed. So in order to see what's the actual change is, let's copy this value and paste as a value in below this. Then we're going to change this one to 6%. See? The value is changed. 5%, 177, 6%, 170. So actually the difference here is this minus this. Negative $6,000 difference. So that's what happens. You can easily see. So what is the impact? The second question, what is the impact if the probability of death increases by 2% each year instead of 1% each year? So back to 5%, right? We don't want to change everything. You can change everything and then show, but starting from the base case, what we're changing here is probably death we added manually 1%. So there are multiple ways of doing that. You can just change it here, I think 2%, and then drag it all the way to the right. This way, right? We change it to all. It goes all the way to 63% of dying each year, right? It increased from 15 by 2% every year. We already got an answer, right? The value decreased as probability of dying increases, right? The present value actually decreases. So the change in the value becomes $19,000 less in terms of total. Now, the third question, what is the value for an annuity with the same specification, but it begins at age 70? 10 years earlier and starting, so that means it's starting at age 71. So when you calculate any present value, it's great to draw a timeline. So here I'm going to show you what I meant here is we're going all the way. I'm not going to draw everything here, but like this. Our case was originally 81, right? It did not specify everything in the question, but the setup already showed you. Our case was 81 and 82. So all the way 105. This is how we did, which means this 80 was our starting point. And then cash flow occurred starting from here, and all the way here. This was our starting point, which is t equals 0, right? T equals 0. You see, there's nothing happened at the beginning, right? This is called ordinary annuity. In a typical setup, first cash flow occurs at the end of the first period, which was our case is 81. You can imagine, right? The person's life is like when the age changes, and then it has a 1 year time period. But you don't have to think about it too much, which point of the year we start, right? But just age 80 was a starting point. But in this number 3, it's asking, what if we change the starting year as 70? The person purchases this annuity at age 70, and then first payment will occur at age 71. So we need to add a 10 years in front, the before 80. So we need to actually change that setup. In that case, right, from here, you're going to have to insert okay, you're going to actually have to insert this cell like this. You're going to have to add it. And then you're going to have to change all the formula. Like I'm saying here, 70 plus, yeah, like this. Oh, I should have added one more. Right. Yes. And then you build the old formula and the numbers differently, because now the t starts from age 71. Oh, sorry, I was right. Actually, we're not starting from 70 here. You're starting from 71. That's how we can calculate the present value. So we didn't need a 70, sorry. we're gonna start actually 71, the first starting point, like this, and then you're gonna build it here. So I already built here for you. And now I'm gonna explain this how you need to set up, right? Starting from 71, and we have 10 years here now, and then you shift t, because in order to use this t value as a power in the discounting, you start from 1, right? You have to shift to this one. Also, probability of dying at age 71 should be less than 81, right? So in applying the same principle, you actually decrease that percentage by 1% every year. So remember, 15 was our setup for the age 81. So you decrease by 1% to 14, 13. It comes down to the 5% at age 71. So this is a reasonable assumption. But here, it did not say that one. So if you can make a different assumption, right? But we just used a similar assumption for the older age, right? But when you solve this type of question, if you want a different assumption, you got to state that one and then calculate it. So, but if you use the same assumption, like a 5% here, now the calculation of probable survival, it's just same formula using this probability of dying, but be careful from the second year, it's conditional. It's the same factor. The formula stays the same, but when you shift the cells, you gotta make sure the Excel actually uses proper formula in the reference cells. So the present value factor becomes 0.95. It's bigger, right? Compared to, oh, hold on. Yeah, it's not, oh, sorry, that's not bigger because discount factor did not change for this one. Actually, present value will be different. And this, let's see. 0.95 is a present value factor, right? The formula still applies using discount factor or interest rate of 5%, right? The same formula. What's changing here is present value, right? Because probability of survival changed. Now it cash flow total present value becomes a 304,000. How much was it this year? 5%. We changed this to 2%. Let me go back to my removing this. All the way back. And one other thing you can actually do here is you give the increase percent like this here. I can type 1% here. And then you refer to that when you build, when you build, you refer to this cell, fix the location, and then apply this. Now, easily you can change in this cell. Instead of 1%, let's say 2%, because it's probably survival changes. But in our answer here, you can answer either building up, right? Accumulating all the changes, or you go back to the original setup and then see the incremental change. So this is the original value, but so when we change it to starting age of 71, the value increased so much. Why? Because you have 10 more years actually to receive, like all year. So the price of this product, the life annuity, should be much higher. So it can be sold at $304,000 now. $304,000. Okay, so that is the life annuity, the case. We're going to build up on this one for the later, the next file. So we have other cases. So, but if you understand this setup, it's not too hard to actually change all this setup. Then now we're going to move to the class 3 file. So if you haven't downloaded the class 3 file, just go to the Google Drive and then download the class 3 file. Now I'm going to share class 3 file. Okay, so we are starting with annuities and geometric series. So we already talked about the annuities. First, geometric series. Sum of a geometric series is in mathematics, the term series actually means sum of an infinite number of terms. These terms is actually called a sequence. So you can see the sequence of numbers or variables represented, but if you aggregate all of them, that's actually a series. So geometric series, those terms have constant ratios between the successive terms, the terms next to each other. So in this case, right, typically you're going to see this type of expression, the A and then A times R, AR. So R is the ratio, the constant factor. So you multiply R to the previous term and it becomes next term. And it's keep increasing by multiplying a certain factor, that constant factor. In this setup, or for the finite terms, right, the power goes to the n. That means we have n plus 1 number of terms here. So how do we calculate this? Geometric series, right? A sum. Just in order to calculate geometric series, like you need to just put this limit sign and then send it n to the infinity, because geometric series is technically for the infinite terms, infinite number of terms, right? So n should go to the infinity, but first we start with the finite terms and then think about it. The question here is, how can we express this sum in a very simpler way? So first you use this aggregation sign, sigma, and then AR to the K, right? K starting from 0 to N. So this is the expression, but this can be expressed in a much simpler way, like this. A comes outside, and then there is big factor in here, inside parentheses. I'm not telling you to memorize this one, because some of you actually tried or you already memorized, but A is a common factor here, right? You can easily take it out and think of it, this one starting from 1 and to r squared only, right? That's simpler. And I'll show you soon how we can actually derive this formula very quickly. So before going that, and because our class work actually has that part, so I'm gonna actually explain the slightly different setup, and the same as your class file. If you did not attend last week, if you're wondering, oh, this file looks different from what you actually downloaded here or from the class, it's because I added some more contents here, and this, instead of writing everything during the seminar to save time. But I'm not sharing these files. So you just, if you want to write down whatever in your file, just feel free to do that. Okay. Annuity, as we discussed in the prior file, is the strip of payments starting and paying at period 1, which is the same amount of cash flow occurring at same interval, time interval, the equal interval. So whether it's a year or a quarter or a month, and the same amount should occur. Depending on the perspective, it can be a cash inflow or outflow. But important point here is cash flow does not occur at time 0, which is present time. There's no cash flow. You start at the end of the first period. At the end of the first period is actually the same as the beginning of the second period. So if the cash flow occurs at the present time, which is much more realistic case, so if you sign up for any insurance product, and I don't know if you have recently purchased any insurance, when you buy the insurance product, you have to pay actually certain amount or the first payment at the time of purchase. That's actually usually initiate the contract, because there should be a certain amount of amount, and then to start and then activate the contract. So annuity due is that case. Annuity due is much more realistic. Look at this, chart I put here. Ordinary annuity versus annuity due. If you look at the timeline here, as I emphasized earlier, for the ordinary annuity, this is just annuity, ordinary annuity. There's no payment here, right? Payment occurs here. This is what I pointed out, cash flow C, right? It happens C, but at time T or nth payment, right? It stops. And now annuity due, the first payment occurs at time 0, right? So in order to compare, right, this annuity due to annuity with the same number of payments, right, we want to consider n payments. So it goes all the way to time n-1, and then last payment occurs here, right? Not here. There's nothing. If you put here, actually number of payments doesn't match, right? So we want to compare apple to apple. So on the left side, look at this. We have a certain factor V we consider, right? It's similar to R here, right? Starting with a V and then V squared, so factor is V, it goes all the way to the V to the N, right? So how many terms are here? N terms. So if we treat this one as an annuity, right? This, you can think of this one actually as discounted cash flow for the first cash flow amount, first payment. Annuity due happens starting with 1. The reason we start with 1 because you do not have to discount the first amount because it's at present time, right? At time 0, doesn't have to be discounted. The next one is V. It goes all the way to, this also needs to be changed, sorry. Yeah. What needs to be changed here? The formula here. N-1 is, this is actually superscript. You gotta fix this one in your file. N-1. So that we have n terms here too. Your file has an n, right? So these terms don't match. So to match the term, so n-1 is the right expression for annuity due. Look, we're not sure what's V, so I'll show you soon after explaining what the perpetuity is. The perpetuity, if this is a name again, is a series of payments that
Next
go
one.
on
Following information
forever.
relates to questions
So
11 through
perpetual
16.
annuity
We have
is the perpetuity.
securities had been
Nothing
reclassified as fair value to P&L.
special.
So if you were confused by this one
An
and couldn't figure it out, if you read the
expression
answer, it said
using
it's an
V
unrealized capital
terms
gain. If
here,
it's a
right?
gain, well, then it
Starting
should be
from
higher, not.
V, it's like the same as
That
just
was the
regular
cost. That is lower
ordinary
than the original
annuity.
cost.
It
So if we're
goes,
basing our
it
coupon
keeps
payment,
going.
well, let's remember those critical
So you can
people.
imagine
First one.
once you build a formula with a finite terms, right? You can use that limit expression to calculate the perpetuity. So now what is a V? Well, you may not have this one, but it actually brings us to the geometric series tab in yellow, right? Which is the first assignment here. So this assignment asks us to calculate the geometric series, which is a sum, right? And this task you can do on the paper and write down if you are taking a class. But for us, just let's see the expression here. From V to the N, right? This is the first setup we saw here, right? Annuity. Let's call it that X. And then we call it, that's the equation 1. Now multiply the V, the factor, right, to both sides. So this one becomes Vx, and then the right side becomes all, like V squared is starting, and then goes to all the V to the N plus 1. Now you can see these terms are the same here, right? All the way to 1 before. From here to here. Now we have two equations, 1 and 2. Now side by side the operation. 1 minus 2. Equation 1 minus equation 2 means side by side. This one minus this. X minus Vx, right? Becomes this. From equation 1 minus equation 2, the right side, right? The common things will be gone. The only this one will be left. V and then V to the N plus 1, right? And the minus. This is the expression right here. Now take out the common factor X, then left 1 minus V, and then same. Now what is our goal? Okay, is there a simpler expression for X? This is annuity. X by dividing 1 by 1 minus V. Okay? This minus 1 minus V. So this is the expression. So to answer these questions here, right, you don't have to go further than this. It's because the question is asking V greater than 0 and less than 1.
Let's see what we have in 2018.
What
if
is the
Cinnamon is deemed
sum
to have control over Cambridge,
V
it will most likely account for its investment in Cambridge using
for
the equity
1 to
method, the
100.
acquisition method, or
So
proportional
basically this is
consolidation.
actually a
For something like
annuity
this, we
case.
don't even have to read.
V to
All the
the
clues
I.
are here. If we're deemed to have control, if Cinnamon is deemed to have control over Cambridge, value than the original cost, our interest income would be lower. And 16. So if you were confused by this one and couldn't figure it out, if you read the answer, it said it's an unrealized capital. 15. Confabulated's reported interest income would be lower. If the cost was the same, but the par value of Bugle was 28, Cathay was 28, Dumas. Well, we know that interest is paid on the par value, interest is not paid on the cost. So what we're saying is that the interest would be lower. So what we're looking for here in all these three things is under what situation is the par value lower than the cost?
Here, number 2, when n goes to infinity, this expression here, right? With a limit n goes to infinity, this, if the V value is not between 0 and 1, let's say it's a positive or even negative, absolute value greater than 1, this value will diverge. It goes infinity. We cannot actually calculate this. So because of this condition, this one is actually not infinity, it goes to 0. if you have not taken calculus, right, it's maybe a little bit hard for you, but that's from the calculus. So this expression becomes only v over 1 over v. Only if the v its value is between 0 and 1. Now, this number 3, let the v equals 1 over 1 plus r. So this is already answering to our question here. In geometric series, what is v? I asked, right? We set up, right, annuity, the v. Annuity, so you need to understand how the annuities the present value can be calculated. So look at this timeline, right? These are all C's, right? You just need to discount all this C all the way to here to the present time, right? Bring it down here. So what we did is C over discount 1 plus R. Next one was C over 1 plus R squared. On the way, see the last term, 1 plus R to the N. If you take it out to C in front, right, this whole thing becomes 1 plus R, 1 plus R squared, one plus R, and look at this whole thing. You go back. This is actually, look at this. It looks familiar. This whole thing, this factor, right? The factor between this is actually V. So using R, right, representing interest rate or discount rate, right? It's a little complicated if you use 1 over 1 plus R all the time, like you see here. If you use that one as a factor, so we just replaced it to make it calculation easier, like this way. And then you just plug in here. Instead of V, it's 1 over 1 plus R. Yeah, so here. So you're going to rearrange this one a little bit. So try it in your paper, right? It comes down to 1 over R. Now, if some of you remembers, right, there was a perpetuity formula. When there is an interest rate given to you, a fixed rate, the present value of a perpetuity becomes 1 over that interest rate. Many of you just remember this one. And I actually recommend you to remember this, but with also remember the condition correctly. This 1 over R, we're not considering the actual amount. It's just a factor, right? So 1 over R, you got to multiply by the actual amount. Second of all, this R is the annual rate. In case, if in our case, it's annual payment. But if you change this compounding, right? We talked about the compounding in the prior session. The compounding period changes with this interest rate. That also works, right? So you gotta think about it. This in this series, we did not actually assume this is annual, right? But typically we see a lot of annual cases, but that's not always the case. You got to think about that one. Okay. So that's about annuities and geometric series. Now, normal distribution. We're getting into a little bit of like a statistics part. I see the question. Why v to the n plus 1 equals to 0? Yeah, so probably you have not taken a calculus. So give you an example here. V between 0 and 1 uses the 1 over 2. One over 2. If you take a square, is what? 1 over 4. Cubed, 1 over 8. Use just 1 million. How much would that be? This is not easy to see. Let's see. I will show you. If you change the value here, let's say 0.5 is 1 over 2. Use this value. At 100 million trillion. Look at this. Sorry. This is the value. Fix it to the power of this. 1, let's say 2, right? 0.25. In order to show you how small it is. Excel does not even calculate this one. So let's not go to the million. Let's go to 1,000, 100,000. Like this. Already, when the power goes really high number, right? It's a small number. If you keep multiplying it, it gets really, really small. And then when it goes infinity, it becomes 0. So that's why when this number is, the absolute value is less than 1, and the power goes to really large number, it converges to 0. So that's why, as I said, it goes to 0. What I meant about this formula, in perpetuity present value, whatever rate is given to you, right, that needs to be matched with the amount. Let's say this case, in our example, prior case, annual amount was given, and then you need to use the annual percentage to calculate this one and then multiply by that amount. Let's say $50,000, right? 5%. If that was a perpetuity amount, right? 1 over 5%, but multiplied by what? The 50,000. But if that payment is, let's say, semi-annual, the $25,000 every time, but you cannot, the compounding happens semi-annually, you cannot use 5%. So you should use 2.5% and then the $25,000. So that's what I actually meant. So now, normal distribution tab. The normal distribution is the distribution that emerges in nature. So first, just look at that graph I put it here. You all remember this one, bell-shaped curve, right? This is how normal looks like. But fundamentally, you got to remember what goes into this graph. Many times, normal distribution doesn't even show the axis, y-axis and x-axis. But you got to always remember there are axes here. X-axis here, even though it shows like 0 and then some standard deviations here, x-axis actually shows the scale of your data, what actually scale is. And then the height of this one, the graph line shows actually the height, which is the value in the y-axis. The height is the frequency. Whether it's absolute frequency or relative frequency, it is a frequency. How many times that data points occurs in your data set. So normal distribution in this shape, when we say, okay, that emerges in nature, for example, think about the people's height. There is a certain, homogeneous data set, right? Let's say in certain age group, right? And then if you measure all the heights, and the average value here, they will have a most frequency, the highest number of occurrence. And then if move away from the average number, that frequency reduces, but that frequency shows this bell-shaped curve. That's what the normal distribution means, right? I know that's basic, but a lot of people forget about that. This normal distribution can emerge when you sum a bunch of small random draws. This is actually called the central limit theorem. If you do the random draw, means create samples by random draw. It's called a random sampling. It does not matter what distribution actually these samples are coming from, what actual population has. If you draw random samples, and then many times the distribution of that sample means will actually have a normal distribution. That is central limit theorem. But we're not going deep into the central limit theorem. But the core statement is the sum of independent random variables, because we draw random samples that becomes independent, are actually normally distributed. The casual example I mentioned, the height, weight of the people, or IQ, or even the stock returns, which are not natural phenomenon, but if you take long time period and then a lot of stock returns data, it actually shows similar to the normal curve. It's not perfectly normal. The perfectly normal curve is theoretical, because also this is asymptotic, which means this tail does not touch this x-axis. It goes to infinity. In real life, it's not like that, right? We see a lot of like discrete cases, discrete data points, which means stock returns also has a certain data point, and then height, it's not going to be smooth curve. So we can draw only smooth curve theoretically, just for your information. The quantiles we're going to talk about. So we draw a standard normal distribution. This is normal distribution, but a specific case. Mean value is 0. And then from mean, standard deviation, well, this itself is not standard normal, but from 0, if you move one standard deviation, right, in standard normal case, that actually becomes a 1, right? The sigma is 1. If you move away, like 3, let's say the standard normal, it's because this is 1, -3 here, that point. What is the actually area under that graph, right? We know the area under this entire curve is 100%. That is our entire population, right? We want to measure, what is the percentage up to certain data points. Remember, this represents the scale of your data. So originally, this was a certain data point. back to the height example, let's say height average is like a 5'5" here, let's say. This could have been like 4 feet here. And then this end could be like what, 5 to 4, 5.1 is 7.5, something like that. So at this point, 3 standard deviation away from the mean value, but negative standard deviation here, 3. What is the percentage under it? And then how can you calculate this one? The quantiles, you measure in the scales here in your x-axis. You remember the quartiles which splits the data set into 4 groups, like 25%, 50%, and 75%. The percentile is actually by 1%, like, right? 100%, 0 to 100%, but the quantiles you can measure any measure here. So negative, when we have -3 here, in standard normal case, there's a function in Excel called norm.dist function, and then use that quantile value and then gives this parameter here. The Excel function I wrote down here, parameter x, but mean value we give 0 and standard deviation 1. So we make this one as a standard normal distribution, right? By giving mean 0, standard deviation 1. Now, the last one is condition. When we write down true or type 1, it becomes the cumulative. What does a cumulative means? If you don't give that as a cumulative, it's a false condition, right? It's typing 0. It will give us the value of the y, which is height at that point, at exact data point at -3, the height of this one. What is a cumulative means? Cumulative means from the negative infinity, all heights added up to this one. So if you recall your calculus class, that is the integral, the operation. So that in Excel, that's what you can do, cumulative. If you use that function, it gives us 0.13%. So below here is 1.13%. This is hard to tell. So let's see the easiest example, 0. Look at the formula here again, using 0, and then with the standard normal and cumulative, right? That means up to this middle point. What is the half of the graph? Of course, that's the 50%, right? So that's how we can use the Excel function to calculate the area under the normal distribution by giving the Excel parameters here. If you recall from any mathematical statistics or calculus class, this graph is expressed in this form mathematically. F of x, this is a probability density function. It's complicated, right? There's no need to memorize this one unless you want to be the statistician or mathematician. But if you take the integral from -infinity to certain point, that's what we actually got here, the values with Excel. This one actually, before moving to the simulation part, this chart actually has data here. So I mentioned about the stock return. Actually, I should have shown this chart at the time. Actual S&P 500 distribution. So S&P 500 is a stock index, from the largest 500 companies in terms of market capitalization. We gathered the data, the historical data of monthly return, and draw a histogram. Histogram means like a height of the bar. It shows frequency. So it looks like around this is the actually mean value. Look at the shape, the orange bars, right? And then this blue line, this bell-shaped curve, it's a theoretical normal distribution. We try to fit it, right? As I said earlier, this orange color is not perfectly normal, but approximately shows a normal distribution. So that's what I meant earlier. Stock return. Now, moving to, well, basics of simulation part. There's a function given to you here, norm dot inverse dot inverse function, norm dot inverse, and then random function inside, and 0 and 1. Excel function, when you don't know what Excel function does, when certain Excel function does, you gotta go actually find it. Google, yeah, you can find it, but also I recommend actually official Excel help by pressing F1 and type the function and see examples. But random function, first of all, gives the random value between 0 and 1, including the 0. Oftentimes we can use this one for the probability, right? Because probability is same, even though it includes 100% 1, but the value is between 0 and 1, inclusive. So you can choose a random probability using the random function. Now, what is norm inverse? The inverse function is returns inverse of the normal cumulative distribution for the specified mean and standard deviation. So first, you also got to understand there are a lot of like steps to understand one thing here. Cumulative distribution function, in short CDF, for this normal distribution above, right? If you calculate all the areas, right, it will ultimately reach to 100%, but starting from the very small number. So that's what this one shows. Cumulative distribution goes, the value goes all the way. It hits 0.5 here when the value is x is 0, right? And it goes to 1. Now, the inverse function is, if you have a value in probability, which is a value in the y-axis, right? Let's say we found the value of 0.5. What is the value of the x pointing back to 0, right? If you found this like a values, random values of probability here, you point back to that. What is the x value here? That's what actually here, let's say 0.8 is going to point out here, and it went all the way down to here. Yeah, I don't see the exact value, but that's what we're trying to find by this function. So look at this, random. We don't see the what value actually went in the random function. You can build a two-step. First, you see the random value, and then plug in that number to the known that inverse function. We will need to use this one for simulation, because simulation, you generate many random numbers and then try that experiment many times. That is how the simulation is built. So this is just the introduction for that. Later, we're going to have a chance to cover the simulation with more examples later. Okay. Now, moving to the next step, data table. Data table exercises, rather than the financial math, this is more than Excel. But for financial math calculation in Excel, using the data table is very useful. So if you have not seen this one, it may not be easy to grasp everything in today. So I recommend you to find the different, the videos and examples and try it here. If you are not taking classes, if you're taking classes, naturally you have to do practice for your homework. But there are tables here. We want to calculate many values depending on the scenario. So we have a scenarios of numbers, but we want to see the result in a table format. The inputs are there are two inputs. So the row values is one input and the column values is another input, right? Different scenarios. And then you put the calculation engine on the top left corner, and then this table will show you the entire result. So a good example is when you want to estimate profit from the revenue and an expense, right here, I'm giving you this input. There are two inputs, one output. Revenue and expense can be different, right? Of course, you can have so many different scenarios, but sometimes in business, it's good to see certain plausible scenarios, right? If you can estimate a certain plausible amount of revenues and expenses, you can put that one and then see the profit. So this is a profit. How is it calculated? Revenue minus expense. So this is how the calculation works. But we want to see it in the table very easily. So you put this input here in the row, revenue and expense in the column. And this calculation is showing, oh, that needs to be revenue minus expense, right? It's pointing this one. So now, when we have this, we select this entire thing, and then there's the instruction on the bottom. In the main ribbon on top menu goes data and what if analysis and data table. Data. I recommend you to do this one with me if you have not seen it before. Data, what if analysis, data table. It's asking you, what is a row input? In our case, row here, you got to point to row input. And column input. Okay. Now, table is filled with the result. See, 200 minus 50 is 150. Like 400 minus 60 is 340. These ones are the outputs. Also, you realize that if you see in the formula window that has a squiggly bracket, right? This one means this entire data set is treated as an array. You cannot just fix like manually here. You can build this one manually, right? Building a formula, this one is this minus this, and fixing the locations, right? It's becoming a lot more manual. Using the data table is an easy way to create the data input, data output with multiple inputs. So this is called a two-dimensional data table because we have two inputs. Now we're going to see the one-dimensional data table, which is slightly different, but same principle. So in this one-dimensional data table, right, the function actually, which is calculation engine, goes to the top of the column. The top row actually has a function, right? Imagine this is not two-dimensional, so this place is not for the calculation engine. But column values, the input values are going to the column, right? Still. So same here, example, we want to see certain value becomes double, right? Based on this input. You input here. It could be any location. You just need to point to this location. You select the data area you want to generate the output. The column is here, then formula is up top. To go to the data table again, you choose this time, right? not the row value, because we don't have a row value. It's just one-dimensional data table has only column input. You point to that input and said, okay. So this is because already in here, it's actually, I will show you here without this. Okay, see, now it's filled. All values, these are multiplied by 2 as we set up on up top. We have table format right here. The reason I'm showing you this one, this one-dimensional data table can be applied in each column in one shot. So here it's double, triple, different function, and let's see this now, even random function. So if you put the random function here, that means we want to see the random values here. It does not depend on this column value, but it will generate different random values here. But actually, that is useful for our simulation. That's the purpose I'm showing you this. So here, if you select like this, go to data table. Again, give the same column input here. Okay. It generates each column, the numbers. So here's the interesting thing. Let's say you delete everything. And then here is rand. If you want to create a random number, I will show you interesting thing. You go to data table and column, you just point out wherever, random place, without any number. That works. Because random function, as you see here, does not require input. So it can point to just blank cell, and it will generate the random numbers here. When do we use this? For simulation. We need to create like 1 million times of the random number and then do something with those numbers. So data table becomes very useful to create the simulation in Excel. Otherwise, you have to program those, random number, and then create the loop and something like that with the coding. But in Excel, we're going to see how we can create a Monte Carlo simulation later. We have a few minutes left, so a few other things here in yellow tab. Number 2, solve for payment, PMT. $1,000 of principal paid out over 10 years, interest rate R. We don't know which one is R is, but make a table displaying the different amount corresponding to a different rate. And use your manual geometric series calculation and match the result with Excel PMT function. You can use the data table to implement if you want. So data table is easiest actually if you have the master how to use it. We want to give just 1% to 10%. You can start from whatever percentage you want. From 0% to you can go to 100% by incremental of 0.1%. It's your choice. So I just chose this 1 to 10%. How do we calculate the payment amount? And using the formula? Well, formula here, right, on the left side, this is a manual calculation. Where does it come from? We saw this one, right? Geometric series. This sum here is expressed in this way, right? Generalized, right? With n. So v minus v to the n plus 1, right? You see, but plug in this 1 over 1 plus r instead of v. We're not using v here anymore, r, right? You plug in that one, you rearrange it. So it becomes this, ultimately. This is a geometric series. but with a finite term, right? We have 10 years. Well, it did not say actually years, but 10 periods with a matching interest rate. Okay, precisely. So you've seen this type of formula in your finance textbook, even though your finance textbook did not explain how. Yeah. I want you to remember this process, not this entire formula. It's really hard to memorize all this thing correctly. So present value of the fixed amount of cash flow, right? The C is the PMT. It's just multiplied by this factor, the entire factor, right? That's a V. I mean, the geometric series, that's X, entire X. So this whole thing, calculating the C is just PV divided by the factor, right? So $1,000 principal is the present value. So you divide it by this factor, that you got to build this one in the Excel. That's what this cell does. 1,000 divided by this whole part. Look at this, 1 minus 1 over. Now you point R. N is 10, it's fixed, 10 years, 10 period. But R is changing, right? So J9 here is R. So you got to build this one on your own, right? Using this R. But in this case, the payment amount becomes $105. You build all the way to, all the way to 10, right? When R is 10%, it becomes $162. Now, if you use the payment function in Excel, it's very simple if you put the inputs correctly. Using the interest rate, 1%, number of payments, 10, and this is -1,000. The principal amount is -1,000. Why -1,000? If you put the +1,000, you will get the negative number amount. So it's because of the direction of the cash flow. So you are paying or you're receiving. So did you pay $1,000 or did you receive $1,000 at the beginning? Then so if it's a cash outflow, and the payments all becomes cash inflow. So that's why the sign actually changes, but the absolute amount is the same. We got a list of the direction. So now if you use the data table, right, you build this one. Input is a percentage, and output you have this formula, right? Manual formula. That's a discount factor, 1,000 divided by this. But now the function for the first one-dimensional data table, up top, all different inputs in the column. So what do? Select the area, data, what if analysis, data table, column input, percentage, okay. And one shot, we have all the matching result to this column. It's much quicker if you are familiar with the data table, but you compare with the PMT, they're all the same. I mean, either you use manually implement the formula or Excel built-in formula, right? That's the same. Dice case, it shows a little bit of more probability concept. The next seminar will be on probability, so we can build on this. Simulate random rolls of the sum of the pair of dice. So dice has 6 numbers, possible cases, right? And the 2 dice, I mean, 1 die has 6 numbers, and the 2 dice is a pair of dice. Now we create the sum of those 2 dice output, and then use the concept of inverse CDF. And then we're going to use a VLOOKUP function, and then less than exact match, approximate match. So I explained this one in the Excel session. So possible cases of die 1 all the way 1 to 6, 1 to 6, keep repeating, because to create exact the pairs, right, to all 1. The possible cases are 36, right? The 36 possible cases. Some you built this, right? Instead of doing one by one, row by row, we just gave a name to the entire data array, die 1, die 2, and then just use the sum. At sign is just applying to each row. So we have some values are here in the column J. Now, what do we do? You got to count the frequency to create this. We're basically creating the distribution, but this case, this is discrete case, right? Discrete variable. So we are creating probability mass function, not the density, probability mass function, by counting the number. So sum, all possible cases is 2 to 12 sum, right? Count. Either you can count like this, count if s and give the condition. The condition is just here. You match this here. Or you can use a frequency function. Either way, you can try both. But don't count manually. You count it, right? Most cases happen at sum of 7, right? You can think of like 1, 6, 2, 5, 3, 4, those pairs, right? 6. But this is how we count it manually. You check total count matches to 36, okay? Now, PMF here, see, I gave you definition, but if you're not familiar, look up, or your old textbook. Probability mass function is a function that gives the probability, exact probability. I said cumulative distribution will be all the cumulative numbers up to that point. So this one is just that count at that point divided by total count, 36, right? So 1 over 36, 2 over 36, 3 over 36, like that. This value is a probability mass function value for this input. Cumulative distribution function is just addition, right? Starting from this, you accumulate, right? From the previous number, add that PMF output. Ultimately, it reaches 1, which is 100%. Now you have a certain distribution and cumulative distribution function. Imagine what I showed you in normal here, right? And this is normal case, right? We have discrete variable with different distribution, but now what we are looking for is, if we have a probability, just random probability here, let's say random function gives 95.2%, can we find what variable is closest to that one, but not just closest, which is less than exact match? Here, you create again the same value of the input, because VLOOKUP works only one direction, left to right, right? Now we're looking up these values, and then we want to look up the input by inverse CDF. The VLOOKUP in this area, column 2, but the condition is 1, approximate match. That's why 94.5.2 is actually falls into 10. It falls between here, right? Instead of going to 11, actually it gives us 10. So we talked about this in the VLOOKUP function in the last week. So life annuity is building on. You got to try that one. If you're not taking the class, you can try on your own. But if you're taking a class, it's going to be your group homework. So this is all for today, right? We're going to continue the probability for the next 2 weeks in the seminar. So if this is complementing your class or you're preparing for your class, look at all you covered in Excel very carefully, right? Then continue to attend the seminar and the class. Any questions?
Yes.
Yeah.
Could you please go through how to create a data table again on Excel?
We don't have time to go over all this again, right? So you can actually attend the class. There is actually there are many video examples out there. You got to try a lot of different examples. So think about this one and then try with it this. There are a lot of practices here. So try it. It's good. Yeah. It's just only practice can make you understood.
Okay.
Any other questions? Okay. If not, thank you for attending today's class seminar. Actually, I hope to see you guys next week again.
Venture. We're left with nothing but the acquisition method on this one. We'll read question 2 and then we'll go up and we'll read and we'll just verify that we have the right background. In 2018, Cinnamon's total shareholders' equity on its balance sheet would most likely be highest if Cinnamon is deemed to have control of Cambridge. Well, if it has control, it has to consolidate, so right away its total shareholder equity will be the combination of the two companies. Independent of the accounting method used for the investment in Cambridge? Well, no, it won't be independent. And highest if Cinnamon is deemed to have significant influence. If it has significant influence, we know it's using the equity method. There's no consolidation. Shareholder equity will not change. So even without knowing the story, right away, I've got A. It will be highest if it's deemed to have control over Cambridge. Well, we don't need to read yet. Let's keep going until we have to go read. In 2018, Cinnamon's net profit margin would be highest if it is deemed to have control of Cambridge. It had not increased its stake in Cambridge. It is deemed to have significant influence over Cambridge. Well, it would be highest if, B is saying if it had not increased its stake in Cambridge. The higher the stake, the greater the share of the profit. So I think we can get rid of that one. It will be highest if it's either control or significant influence. And we're talking about net profit margin. The net profit will be the same no matter which way we go. Whether we consolidate and remove the part of net income that doesn't belong to us, or whether we just take the portion of net income that does belong to us, net income will be the same. But without consolidation, sales will be lower, which means that our net profit margin will be higher without consolidation. So C, it is deemed to have significant influence. Margin will be higher with sales will be lower, which means net income will be the same. But without consolidation, sales will be lower, which means that our net profit margin will be higher with sales income that does belong to us. Net income will be the same. But without consolidation, sales will be lower, which means that our net profit margin will be control or significant influence. And we're talking about net profit margin. The net profit will be the same no matter which way we go. Whether we consolidate and remove the part of net income that doesn't belong to us, or whether we just take the portion of net income that does belong to us, net income will be the same. But without consolidation, sales will be lower, which means that our net profit margin will be higher without consolidation. So C, it is deemed to have significant influence over Cambridge. So 3 is C. It's rather a letdown that we don't have to read anything to answer these questions yet. Let's just, is it a massive equity? Just if it, we're going to 2 and 3. Let's see what we have for number 4. At December 31st, 2018, assuming control and recognition of goodwill. So we're going to assume that we have reported debt to equity ratio will most likely goodwill or partial goodwill. Can you see one answer that we can eliminate right now? It says here assuming control, goodwill or partial goodwill. We're looking at the debt equity ratio, our numerator is unchanged depending, regardless if we use full goodwill or partial goodwill, it's not going to affect the equity. And the question is asking which will give denominator effect on equity, and we saw that partial goodwill had the smallest effect on shareholder equity. So shareholder equity would be lowest under partial goodwill. Margin in 2017, if it is deemed to have control of the same. Well, now we do have to do some work here. Operating income 26 by 1400, you'll get 9%. So let's find out if it's higher or lower. Here we'll take the 142 and we must add the 88. So we'll have our numerator is 230 and our denominator will be 1575 plus 1100, which is 2675. So 230 divided by 2675 is 8.59%. So we went from 9% operating margin to 8.59% by assuming control. And the question is asking, if it is deemed to have control, its operating margin in 2018 will most likely be A, lower. Following information relates to questions 6 through 10, and it's laid out the same way as the first one. we have a little bit of a short the 974 easy. Our consolidated sales would be, we just add them together, 2018 would be highest if ZIMT is deemed to have control, highest if ZIMT is deemed to have significant influence, or independent of the accounting method used for the investment in Oxbow. It's net income. Well, you can't manufacture net income. Net income will be what net income will be when you add the two together and you subtract the portion that doesn't belong to you. That's consolidation. Or if you don't add the two together and you just add the portion that belongs to you. If you're getting 50% of the net income and you add 100%
seminars with the break of Thanksgiving, the weekend. So today, we're going to discuss the stock market, primarily the secondary markets. And I'll discuss the difference. So the secondary market is the actual trading of stocks, where the primary market is where the company goes out and raises money, like an IPO. That's going to be discussed on October 7th, okay? I did also put a spreadsheet here. There's some reference to the book. This is the book. Actually, I've been getting a lot of data. This is the book I wrote about 2 years ago, and it has all the data. But this is one of the spreadsheets the book has with the figures, okay? So with that, let me launch my PowerPoint and can start. I hope you guys can hear me. Okay, we might touch a little bit of valuation, though we have a whole section of valuation, which I'm going to go over, but I'll touch a little bit because it's a very interesting subject. At the end of the seminar, I will do like a quick and dirty valuation, but we have a whole hour and a half just on valuation. So I added that because we're discussing about how do you measure the stock price? What do you think is a good time to buy and sell and things like that? So today we're going to discuss the stock market and the secondary markets, specifically the stock investments, okay? Now, of course, as an overview, buying and selling stock is probably the most common activity for an individual that just started. You know, they're into it, they have the little gambling mentality. I say, I want to invest, which will I shall invest? They're investing the first time. They look at the stock market, they're fascinated with the stock market, but they don't really know, some of them don't know what exactly it is about. It is, after all, actually, it triggers everyone's curiosity because there is a company behind it. And you guys see the products every day. You see Lululemon, for example, is one of the most successful stocks because you see people wearing the Lululemon pants, and it says, okay, can I invest in the stock? It's a very good concept. So those are like kind of curiosity that starts, so you can share and get, you can make money out of something that you believe in it. Now, the most common question I get, of course, I've been teaching this and I've been in the market for 30 years in banking. It says, what company you think I should invest in? Well, asking me as a kind of expert, well, I'm not an expert in the sense that you see it every day, but an expert on more than the common people. I always can find risks and also upside and downside every stock. So it is not, even the experts, they are getting wrong. So everyone has that basic understanding, of course, that if you buy the stock of the company today, they assume that the value of such stock will go up based on their success of the business. And that's true. Warren Buffett, which we'll discuss later, that's exactly how he picks stocks. He picks solid management, solid companies with solid products, and he sticks with them. And if they have a good product, they will make money, And so that's the success of the business, definitely attributes to the stock price. So if you feel that the company is going to be successful, that's the most basic value, basic analysis you want to do on a stock. Now, investing in companies have good businesses and good products, of course, is expected by the most sophisticated investors. They add few criteria. So if you look at some of the sophisticated investors that you pay money for it, and the active investors, they have some criteria that they use all the time, and they come up with some recommendations. We're going to discuss some of the criteria today. What are those expert analysts do? What kind of work they do to make sure that this is it's a good stock to buy, and they get paid a lot of money just to recommend. So this will include the risk, of course, and how long you will need the money, how long you actually hold the stock. Okay, what are the based on the performance? What is the relationship of this stock to another stock, this asset class to another asset class, the relation between risk-free rate, like a treasury versus the stock. There's a lot of things going on through the analysis over and above what the company does. Okay. So all these questions need to get addressed, and hopefully I can give you a nice overview today about how the stock market works and how experts go about in picking stocks. Even the experts are wrong for many reasons because the expectation hasn't been met, for example. Now, there's one of my favorite books, which I went and bought about 100 of those, actually. I ordered 100 books on Amazon. They're about $10 each, and I give them in class. It is a book that Scott Patterson wrote way back. This is a little older. It's right after the financial crisis in 2010, I think he wrote it. But it's very relevant to any stock movements. And the book is called The Quants, How a New Breed of Math Wizards Conquered Wall Street and Nearly Destroyed It. And it's a fun read. Actually, he's not that technical on the book. He does discuss some technical analysis, but in general, he's very fun to read. It's just for the layman's people that you can read it and you have fun with it. But it basically covers many of the investment concepts that were described here and we discuss later, such as the capital asset pricing model, which is used for evaluating the expectation of the stock. We're going to have a whole section on that on the valuation side. It's called the CAPM. He also uses a lot of the formulas analysts use to set the return expectation and discuss the market beta, which we'll discuss that much later. But the book discusses using a lot of humor, and that's what I like about it. And it specifically, it discusses 4 math geniuses called the quants. So the quants are like 4 guys that they come up with a quantitative funds, and they're well known today, by the way, and aim to take advantage of inefficiencies in the equity markets. So these guys are very technical in nature. They look at patterns of stock going up and down, and they try to pick stocks that they are way below and then sell them when they are above. A few of them they mentioned is Peter Mueller, which is a mathematician that came up with a good concept called momentum. Ken Griffith, it's a founder of Citadel Investments, still very successful, and you can see him on the news all the time. You can Google this guy. This guy's a little eccentric. He bought one of the most expensive apartments in the city, $250 million. Cliff Asness, my favorite quant. He's a PhD from University of Chicago, and he actually is a founder of AQR Capital, and he actually trying to find arbitrage opportunities between many asset classes, including the stock market. And then you have Bose Weinstein, which is a chess master and a mathematician, a card counter. This guy was part of that whole the movie 21, which is MIT students that they found ways to count on blackjack. So he was part of that. So he came up also with their own fund. And this guy traded at the Deutsche Bank. He's part of the Deutsche Bank SWAT and options team. So all these guys are fun, and those are guys are non-traditional in how they pick stock. But it was a fun book because it is in contrast with another great. The other great is Warren Buffett. So basically, it is you can use mathematics to pick stocks, and you can be successful, I guess, though it's getting more difficult now because there's machines and robots and that built already to pick stocks and find efficiency. So, and the market become a little more efficient, more difficult to predict. But then you have Warren Buffett approach, which is basically is picking the right stock. Warren Buffett, I remember I worked with him on a large deal. He went and bought Heinz ketchup. Heinz, which subsequently they bought Hoffman. Heinz actually, it's a 155-year-old company making ketchup and making tomato sauce. And they're making money every single day, every single year. They're all profitable. They grow about 4%. And that's the kind of businesses that Warren Buffett goes. It picks up a longevity, a stock that's going to stay forever. So that's, of course, he missed a few of them. He's one of the largest holders of Apple. I guess he saw that Apple is a utility company. It's going to be always there. People buy. So that's the other approach, is fundamental approach versus the book, the more technical approach. And we're going to discuss those two, and I'm going to give you some insight, at least, of the different ways of picking up stocks at this point. But before we do that, let's discuss how the markets work. Now, we call it secondary market because if you think about it, a primary market is when the company goes out and issues shares. Let's say through an IPO. A company raises money to grow. So they go out there to the people like me and you and just say, look, I need to raise $1 billion. And everybody comes in and gives the money to the company. So the company raises the money directly. They issue shares, which means in exchange of your money that you buy in the IPO, you get a stock certificate that you're a proud owner of the company. And the reason you're doing it is because you believe in their success. And if the stock does well, then you can sell it and make money. Once the company raises the money, this stock certificates, if you will, the stock that you're holding, you can sell it to someone else. And that's called the secondary market, is when you have one investor sell to another investor. And to do it, you got to go through the exchange markets. There is a clearing house. There's a third-party intermediary with all the investment banks. And their job is to find the buyer and the seller of those trades. Some of the exchange markets are very national exchanges, like the New York Stock Exchange and NASDAQ. NASDAQ used to be an over-the-counter. Now it is a fully exchange markets. And those are the places where the companies list their stock. So when they issue shares in the public, this public stock has to be listed so people can use it to exchange it. Now, once you list it, there are many requirements for the company, of course. We'll discuss the requirements later, but it is not that easy of listing your company into the New York Stock Exchange. There is a minimum amount of size of the company. So Joe's Pizza around the corner cannot go to the New York Stock Exchange. It has to be a minimum threshold what the capital they're raising. There's also a threshold what the profit of the company or the loss, but there has to be a large revenue-based company with making actually selling. Of course, there are exceptions to the rule, but in general, you have to be a sound, good company to go to the New York Stock Exchange. And we'll discuss some of the nuances there in NASDAQ. Now, there's few other alternative trading systems that you can buy stock in dark pools, and we're going to look at those too. But in general, if you want to buy stock, you call your broker, and you just and the broker will go into a New York Stock Exchange, will put the order in, and then we'll get you the market price. Okay. Now, before we get into the dynamics of trading, let me give you some other stuff that you see all the time on TV, and maybe you know about it. Maybe this is an introductory class, by the way. They have these indices. So you hear all the time, the market is up, the market is down. What does that mean, the market is up, the market down? Well, basically, they're looking at one index that follows 30 companies. Now, this is one of the oldest index. It's more than 100 years old. It's 30 companies, which probably 100 years ago, 30 companies was a lot. But as you know, it's a lot of companies out there. So it's not the best index to look at because it looks like the top 30 companies. And by the way, this is the Dow Jones Industrial Average. That's the market that they're referring to. It's only 30 companies. They don't include transportation companies because they rely on oil. They don't include utilities because they do have a separate index for that. So it's basically industrial companies. Now, 100 years ago, all the companies were industrial. Now, companies have shifted more services. You got technologies different. So, but because it's the traditional Wall Street, they still use the Dow Jones, which is basically a sum of 30 companies. And then they divide the prices of each company divided by some divisor, which changes. So it's almost, they started divided by 30, but then the stock prices change in terms of splitting and reverse splits. So they constantly adjust in the denominator to keep a constant increase. It's not the best approach, but everybody's looking at that. So I always say, if everybody's looking at it, then use it. But the best measurement of the economy and how the stock market is doing is the second one, which people use that actually in every textbook. They use it also in every comparison of the portfolio. It is called the Standard & Poor's 500, the S&P 500. This, by the way, it is 500 largest companies in the US. So a much bigger representation of the economy, and includes from cable companies to healthcare, to technology companies, to transportation, you name it. Every large company is there. It's 34 different industries. So it is a true measurement of the US economy and the global in some sense. And also it is capitalization weighted. So they don't take, like the Dow Jones, all the prices and they add it together divided by 30, for example. They do look at the size of the company and make adjustments on their weight, because like Apple, which is one of the largest, it is the largest company in the world, has much bigger weight how the stock moves versus some other smaller company. The Dow Jones doesn't have that. So sometimes you see the Dow go up, and because Apple is up and it has such a big weight that it shows that everyone is doing well, but maybe it's only one company bringing and all the other companies are down. So there is some benefits of using the S&P 500 to compare, especially when you're picking up stocks and you want to compare. We're going to go through that again. Now, how does a type of order, what kind of orders, how does people actually trade? Well, there are two types of orders in general. It's called a market order. This is basically calling your broker and just say, hey, John, I like to buy Apple. I like to buy Starbucks at the $100, whatever, buy the Starbucks, whatever the price of Starbucks stock is. So the broker will go out and actually put in the order. So the orders come in electronically with the demand of buying 100 shares of Starbucks or 100 shares of Apple, and they hit the tape, right? And whatever the price is, that's what the price is they're going to buy. There's no specific price except buy me Apple at whatever the market price. And if you look at, this is a table I have here. So this is market makers. We'll discuss market makers later. But Merrill Lynch company is an old one, I guess. Merrill Lynch, which is part of Bank of America now, they have a bid on ABC company at $112.50, which means I am buying stock at $112.50 and I'm selling stock. And those are more like dealers, which I'm going to discuss more later what dealer is. They're holding their own stock. And they also put the size. So if somebody comes in, these are 10,000 shares. Somebody says, I want 100,000 shares. Well, they're going to get the best price from Merrill Lynch. And then if there's still more shares, they're going to go to the next one, and then the next one, and the next one. But you see the prices are different. So they're trying to get the best price possible as the prices are out there. So that's why the trading prices change slightly because there's so many orders of demand and the price goes up and down based on that. The other type of order is called the limit order. Limit order is when you call your broker and say, I want to buy Starbucks at $100. Yeah, but Starbucks is only 97. Well, I don't know. I want to sell Starbucks at 100 or buy at a 95 at Starbucks. But Starbucks at 97. So, well, when it goes to 95, buy it, basically. So if you can buy a 95, I want a 95. So they put the order in at 95. And throughout the day, if he doesn't hit that order, that limit order then goes away, and you have to put that limit order the next day. So people put in specific prices that they want to buy and sell, and that's called a limit order. And versus the market order, you buy whatever the market gives you. Now, there's some other caveats: stop order, or stop loss order, or stop buy order. And so basically those, you tell your broker when the price goes to 100, sell it, for example. Or when the price drops to a certain level, sell it. Those are different than limit orders because you're giving instructions when the stock gets there. When that stock gets triggered based on your instructions, then your stock goes in as market order. You're never going to get exactly the price that you have. You just trigger the price when the stock drops, for example, you want to sell or buy, and that's basically the stop loss order, okay? Now, there are two types of markets, or two types of intermediaries that they actually buy and sell the stock on your behalf. They call it broker markets and the dealer markets. Now, the difference, of course, between a broker and dealer is that the broker cannot hold any stock. They are purely taking the buyer and the seller, try to match their price, and they get a commission out of it. Where the dealer holds inventory, actual stock, is holding stock on their own, and they can sell it from their own inventory, plus they can broker with other third party. Now, being a dealer, it is a very difficult to get license on that because you got to make sure there is not a conflict of interest. You're not selling your own stock at a high price. You got to sell it what the market is giving you. So they're getting double the check and balances. How much of the inventory you can sell or buy? Because you are actually creating the market yourself. So there's a lot of scrutiny how investment banks actually sell their own inventory. So it's a different license. And of course, you have to get all kinds of exams. You have to get all your Series 7 for trading. And as a dealer, you get your dealer license and things like that. Okay. Now, there are trading strategies. There are a few trading strategies I want to go over. And so buying on margin is when somebody says, I'm buying on a margin, or buying without a margin. Buying on a margin means you borrow part of the money to buy the stock. And one of the benefits of borrowing, because the broker, or sorry, the dealer, or the investment bank that gives you, or the bank that gives you the loan to buy stock, one of the benefits, and the biggest benefit, is that when the stock is doing really well, you can make more money, you have a higher return than if you bought it yourself outright. It's called the leveraging effect. When you leverage something and things go well, that's very important, then your return is much higher. But if things go bad, then actually has a bigger impact. So you might make sure that when you get a loan, you're very confident. Now, there is the loans against the stock, they're about 50% or lower. Back in 1930s, people would borrow all their money to buy stocks. Today, there's some certain rules, especially people like us, we're not experts. They have to do a suitability. Then we look at suitability, how much money you have in the bank. Are you wealthy enough to cover the loans if things go bad? So I do a lot of that kind of stuff to get you a loan. Like anything, when you get a loan or buy a house, of course, they're going to double check your credit. They do the same thing. But let's look at an example, how the buying on a margin enhances your return. So let's say you buy no margin. I'm going to look at the second line. So you bought a stock at $100. You bought 100 shares of a stock at 100. So 100 times 100, that's $10,000, right? You spend $10,000 negative. And then going down, stock goes to 120. You sell it, 120 minus 100 times 100. You sell it 120, you get 12,000. Was simple. 12,000 minus 10,000, you get a profit of 2,000. And if you look at the return on your investment, which is the HPR, I call it, is the profit over your initial investment. So 2,000 divided by 10,000, that's 20%. So your money grew 20% basically. It went from 10,000 to 12,000. So you had a 20% return. Okay. So let's look at buying on a margin. You still buy $10,000, 100 shares times 100, but you borrow 50% of that. So you borrow 5,000, and let's say the bank charges you 5% a year. Okay. So basically, you come up only with $5,000 your own money. So that's your initial investment, 5,000, and you borrow the other 5,000, right? So the stock goes to 120, using the same example, times 100, that's 12,000. The first thing you do, that you take the $12,000, you pay back the loan, and you also pay back, this is a 6 months. Let's say after 6 months, you sold the stock, it's 5%, sorry, a year, sorry, it's a year. So assuming it's a year, so 5% on 5,000 loan, that's $250. So you pay 5,000 plus another 250 for the interest. That's how they charge you for getting a loan. Nothing is free, by the way. So if you take 12 minus 5 minus 250, I get 6,750 of net cash. If I subtract my 5,000 I put in, I made 1,750. But because I only put less money, 1,750 divided by 5,000, my return now is 35% return. I mean, think about it. I put in 5,000, I made 6,750, so I made 1,750. And because of the leverage and the how cheap you can borrow, you can make money. Of course, the higher the stock goes, the higher the return, and much higher when you leverage it, because the 5% the bank charges you, that's fixed. That doesn't go up and down. So think about if somebody gives you 30% and you leverage it, that's even higher than 30%, because half of it you bought at 5% and you made 30%. Now, if the stock goes down, that's a different, and you have to sell it, that's different, right? So if the stock goes down to 80, when you're not margin, let's look at the no margin first. Well, you get $8,000. Since you paid 10 minus 8, you lost $2,000. So you lost 20% of your money, basically. 2 out of 100, the other 10, you lost 20%. But look at the effect on leveraging with the margin. You sold the stock, let's say at 8,000. You have to pay your $5,000 loan. That doesn't change. Minus a 250 interest. So net, you only got 2,750, but you invested 5,000. So you almost lost half your money back, half your money. So that's 45% negative. So the leverage has a big effect. And the financial crisis we have in 2008 and all the crises I've seen in the past is due to leverage. People actually borrow a lot of money against the value of the stock. When the value of the stock drops, the banks will come to you and says, look, you went below your margin because you have to keep 50% of the time. So either you're going to put more cash to cover your loan, or you have to sell the stock so you can pay back the loan. So if you don't have any cash to cover the loan and bring it to 50-50 margin all the time, then they're going to force you to sell the stock. Now, the banks make a lot of money on this because they get the collateral of the stock, which means they only give you 50% of the stock. So for the banks to lose money, the stock has to drop in half before they lose money. And before it drops, they're going to force you selling anyway, unless we have a catastrophic financial crisis, which happens. And even the banks actually lose money because it goes below that 50% threshold. But the banks can recover easily you know, the stock, unless the stock is really the specific stock, it's a corruption or something and it goes to zero. But because they do so many loans across a lot of the other, you know, they anticipate 1 or 2 companies or 5 companies or 10 companies to go under. So it is a lucrative business for the banks. They have a nice cushion of 50%. So it's that's why they charge you only 5% in this case. The other strategy, which you heard a lot, is called short selling strategy. You hear all the time the guys, you know, selling short. Now, selling short, which is not recommended by any means, especially us, we're not sophisticated. Basically, you are very negative on the stock. So how do I make money if the stock goes down? And one way, and the most expensive way, is selling short the stock. Now, selling short, this is the process where an investor borrows the stock from someone else, sells the stock at the high price, and when the stock goes down, they buy back the stock and they give the stock to the previous owner. Now, the way I can explain it, which is actually a fun way, let's say somebody comes, let's say you call your friend and he says, can I use your car for the weekend, right? And you tell, yeah, the guy said, look, yeah, just you can use my car for the weekend. Bring it back on Sunday, please. On Monday morning, when you come back, I need my car back. He said, no problem. So let's assume, hypothetically, you take your friend's car on a Saturday, and you, for some reason, you walk into a dealer and you sell his car without telling him, right? You sell his car. Of course, titles are in there. You sign it or whatever. Of course, you go to jail. But anyway, but try to make it a little more fun. You sell his car on Saturday for $30,000, and now you got his money, right? He doesn't know that you sold his car. And on Monday, on the way back, you go to the dealer and says, you know, that bag I sold you, I want to buy it back. And the dealer says, look, I wasn't able to sell this weekend. I had an open house. Nobody bought it. So I'll sell it back to you lower because I don't want to sit here and say, okay, I'll buy my car back at $25,000. And the dealer says, okay, just take it. I made a mistake. I couldn't sell it. So here's your 25. Here, I'm going to pay $25,000 and get your car. So I show up to my friend. I gave him his car. He doesn't know anything, but I made $5,000 on his car because I did borrow, and I was expected the value of the car will go down. The same thing with short selling. Short selling, you actually borrow the stock. You sell the stock that you borrow. Of course, you have to, there's a process. It's not that easy. You just have to mention your intention that you sell the stock, which is called short selling. So the broker will lend you the actual stock. You sell it and get the money. The money will be placed in an account. You can't take the money yet. And you're hoping the stock goes down so you can go and buy the stock at a lower price. And then you hand back the actual stock. And then hopefully you made money because of the difference. There's some, this table here will show you some examples. Short selling, let's say the stock is trading at 100. You sell it, and that's why you receive $10,000 credit. If the stock goes to 50, which is a huge drop, let's say 3 months from now, you went and buy, you pay $5,000 to buy the stock, and you release, the credit is released, so you made a $5,000 profit, right? And you can look at different levels. So the break even, of course, if I bought 100 and sold at 100. But what happens a lot of times, the stock goes up. And that's a problem for a short seller. It's very dangerous. A short seller can have an unlimited loss if they're wrong. If the stock goes up, then you have to go to the market and buy it at more expensive. So therefore lose money. And you can see here, if the stock goes from 100 to 110, since you don't have the stock and you have to buy it, you got to go to the open market, buy the stock 110, pay 11,000, since you got to receive 10,000 short selling, you lose $1,000. And that's how short selling works. Okay. Let me see if I have another thing on short selling here. Yeah, sometimes they say a short squeeze. There's some words are called short squeeze. Short squeeze is when the short seller are wrong, when they anticipated the stock is going to go down. Instead, the stock goes up, so they panic, and before it goes even further up, they will actually put an order in to buy at the high price so they can at least recover some of the losses. But the problem is, if everybody's going out there to buy, you're pushing the stock up, and that's called a short squeeze. Sometimes when I'm sitting here looking at the stock increase dramatically, especially a stock is not doing well in the past, I always said is the short squeeze. It looks like they were wrong on the stock. There was a great story about 2 years ago during COVID. It was the GameStop. If you read about the GameStop, and GameStop was a classic short squeeze, and there's another called gamma squeeze. Even the brokers were losing money, but it was exactly that. It was the revenge of the nerds, the app guys, Redding and those guys, basically continue buying the stock on the way up, pushing the stock up, and they weren't selling. So the short sellers, Wall Street actually lost a lot of money. As you know, GameStop, it's a company that sells games, and they thought it would be the end of the GameStop will be the end of the company, because the way they sell traditionally, it's in a store. I used to take my son to GameStop, and we just go on the shelf and pick up the actual CD, like a DVD, and you call home, you put in the Sony PlayStation. But now, as you know, everything is downloaded. So those stores probably they're going under, and that's what GameStop was. So there was a big short selling of GameStop because the revenue was coming down. The problem is that, and there was also at the time the CEO had to retire, so the stock was trading around $10. It was going all the way to zero. So a lot of short sellers that were selling the stock when it goes to zero, make a lot of money. But then Reddit got in and stopped buying the stock at $10, and they righted the stock all the way up to the hundreds of dollars. And all the short sellers that got squeezed, which means they had to go and borrow money to buy the stock at much higher so they can cover the shorts. And that was a fiasco that was written everywhere. And if you follow the story, it was a very great story. And the story was also on the cinemas, the movie AMC, and a few other kind of traditional bricks and mortars type of companies.
Professor?
Yes.
I have a question about the shortage. So if the price go up and they have to borrow money or borrow stock from their friends or other people, they just have to have the minimum balance of half of the 50%, right?
Yes. So yeah, go ahead.
They just stay there and then they wait until the price drop back? Is it what they do?
Yeah, basically, let me give you that. There are three scenarios, right? The first scenario, you borrow stock. Let's use a friend so you can understand. But this usually is the brokerage firms that will give you the stock. So you borrow the stock, you sell it, whatever money you get, you put into a credit account. They don't allow you to spend it. It stays in an account, right? And then you're waiting for the stock to go down. That's the first scenario. If it goes down, you go and buy the stock at a lower price. And then you hand the actual stock to the broker. Here, I borrow the stock, here the stock back. And because it went down, you can keep the money, the original money minus what you bought him, right? So you make profit. So that's the first scenario, right? The second scenario is the reverse of that. You borrow the money, you borrow the stock, and you sell it. You keep the money in the bank account, but the stock goes up. So what happens when it goes up? The broker says, hold on a minute. you owe more money. The stock is actually higher than when you sold it. So
Yeah.
you have to put cash into the credit. You have to put money into the account, or you have to go and buy the stock now at a high price.
Oh.
And admit you lost money. So if the stock was 100, 120, you have to go out, find another $2,000 for 100 shares that you borrow to go and
Okay.
buy. So you lost $2,000 because you need to pay more than what you got, right? So that's the problem. Now, the third scenario, of course, is to continue putting cash into your account, because even though it went up, it will go down at one point. And you're waiting, you are very patient, and it goes up again. You have to put more money into your account, and then hopefully it goes down again, and then you can actually buy the stock at a decent price, hopefully below what you bought it. And that's basically what many short sellers do. They just be patient sometimes. And they're short selling because they're waiting for some kind of announcement, some negative announcement or something, or they don't believe in the management, or there's something that they believe the stock is going to drop. Okay.
Okay. Can a company like borrow from another company if they own the same stock?
Well, the companies don't get involved in short selling, and it's illegal for them to,
Oh.
because they're insiders. They can't really. We're talking about
Borrow.
us, you and I, on the secondary market. Yeah.
Okay.
There's
Thank
some
you.
exceptions. When I'm talking about very general stuff, but yeah, the companies don't borrow, their own stock or whatever. Okay.
Okay. Thank you.
Thank you. The one page I wanted to, well, the previous page, I don't want to get into too much. Of course, if you own the stock, and some stocks pay dividends. So not all stocks pay dividends, by the way. Actually, most of the companies out there don't pay dividends. Dividends is when the company's profit, they can share their profit with their investors. Usually the companies that pay dividends are more old-fashioned, old companies. They've been there for many years. They don't really grow as much. But companies like Tesla and those guys are growing, they don't pay dividends because they take the profit and put it back. And if they have profit, they put it back into the company. But if you get paid dividends, there's many dates you have to deal with. Is the day that you actually get a payment, is the day that the company announces a dividend. And also, depending when you buy the stock, you can be entitled to the dividend, or you cannot be entitled. For example, if they're going to pay a dividend tomorrow, and you buy the stock today, you won't get that dividend tomorrow, because there's 2 or 3 days for clearance. So you got to make sure there's a T+3 transaction day you buy the stock plus 3 days that you might not allow to get the dividend. So the dividend, even though I sold my stock, I still get the dividend 2 days later. And that's you have to be careful about that. There's a lot of discussion about that and the math behind it. Okay. Now, just going to the program trading, there are many kind of trading platforms out there, especially now these days. As a VC, I work for a VC. I'm an advisor for a venture capital European. So I see a lot of technology, fintech companies that they're building algorithms, especially in the cryptocurrencies, a lot of them these days, but a lot of them also in the stock market. And the different algorithmic trading. So when you look at algorithmic trading, what it means, they're computers that they're built to look at some of the technical movements of the stock and try to predict the movement of the stock next. So they're powerful computers doing that all day long, buying and selling at a small amount, at a small incremental change, but they're selling so much that they can make money. And so that's it's a lot of them out there. And sometimes it works, sometimes it doesn't work. In my experience, it works when the market is normal, when things are normal. When the market takes a beating, like a crash, which I call it more than one standard deviation. In other words, it drops more than the average by a lot. Then even those machines fail to predict, because the machines only predict, they can predict, let's say 64 to 94% of the time. but is that other, the other 6% that it might happen that it might not work with this thing. Then you have the other one, high frequency trading, which there's great books, by the way. They're beautiful books to read. High frequency trading it's another book. It's called Flash Boys. It's a red book. Flash Boys was about these guys came up with a fiber line. They put a fiber line from Philadelphia to New York to go ahead of everyone's trading. So when they see the stock changes, they can buy ahead and then sell it. Talk about a millisecond. They buy the stock 0.1 second and they sell it within a second back, and they make money on the difference. And those have many things that they build, how quickly frequency you can buy and sell, that you can make money on small movements of the stock. Okay, especially in inefficient market like over the counter, people don't really know the price that well. They have a gap in between bid and ask, so they can make money on the differential. And then you have the dark pools. There's another great book. It's called Dark Pools. Dark pools is basically trading programs that they don't show up in the actual trading book. You don't really see. It's basically massive trades between institutions, and it's a very proprietary trades. So let's say JP Morgan Chase is selling to Citibank. Those massive sell-offs, especially big trust, you don't really see them, and they call it dark pools because if you see what they're selling for, they might affect the price of the stock market. So they keep it confidential, private on the side, especially very large positions. Okay. Now, when I pick up a stock, stocks are based on, if you think about a stock, right? There's not much information on the company. I was fascinated with this since early age, looking at the stock price. I said, why does the stock go up and down with no information on the company? Because the information that comes out of the company is every quarter that they announce their earnings, right? They announce that the stock, the company is doing well compared to last quarter or last year. And every year, they have a big report, the annual report that they have to take out. And they're required to have this 10K. And from that, you can determine if you want to buy and sell. But yet, stocks trade every minute, every day, every hour. It goes up and down. There's some information that comes in. CFO quits, or new CEO, or there is a discussion, some conference that people discuss their outlook. But in general, stocks move up and down, not on fundamentals. I just mentioned you fundamentals. Basically, they're moving up and down because they're profitable or they have losses. They're company specific. They move because there's so many technical areas. People, like I mentioned, like the quants, they don't care what the company does. They are studying the patterns of the stock. And the patterns of the stock, they are trying to make money just movement of the stock. And they look at systemic and non-systemic movements of the stock, and they try to make a decision. And then you have the behavioral thing, which is huge. When there is discussion on recession, when there's a discussion on, that the market is going to collapse, then you hear and you read about it a lot. You try to get out of the stock, you try to sell. It doesn't matter what company it is, you're going to try to get out. And maybe it says, okay, if the stock market drops, I'm gonna be able to go on cash. And there's a behavioral thing going on. Even when the stocks are going up. Like, for example, if I look at Tesla stock, and if I had to dissect Tesla stock the way it's trading, right? Is Tesla really a stock that is, what is that? What is the price of Tesla? Let me check Tesla stock just to give you an idea what I'm talking about. Tesla stock is $244. It was down 4%. So $244, what does that mean? Is that a fair price of $244? Now, if you use traditional valuations, which I'm going to show you hopefully today. And I have a whole section on that. Probably Tesla stock is only worth 100 or 120, let's say. Why? Well, because I look at the profit, I look how many cars they make. They're growing nicely, 20% a year. So they should be growing 20% a year, and the stock should be growing 20% a year, but it's been growing faster than that because there is another factor that drives the stock. It could be a technical factor. So people are moving money from one company to the next because they have more momentum of Tesla and everything else. Or it could be behavioral. People love Elon Musk. So I don't care what the stock is trading today. This guy's genius. He's going to come up with some other idea. He's going to actually do well. So people actually invest because of Elon Musk. So there is a lot of embedded value in the stock more than the pure fundamental, which is what is the profit that this company makes. And so that's a lot of factors which makes it more exciting how people can go in and out of the markets without, there is room for everyone. It's for the behaviorist, room for the fundamentalists like Warren Buffett, and also room for the technical guys like AQR and those companies I mentioned, those funds that they come up with quants. So we're going to go through each one of them to explain. So let's look at the fundamental analysis. Now, there's certain fundamental companies, some fundamental analysis based on expectation, right? So there are three types of companies. The one company is called growth companies, other companies are called income companies, or value investing. Growth companies are companies that you don't really care about the dividend. You are buying the stock because the company is growing, like Apple, like Tesla, like Meta. As they're moving to the next generation, like Amazon, they're moving to the next generation of continue reinventing themselves and continue to grow. And the profit they're making, they put it back into the company so they can make more profit. Those are growth type of companies. Income companies, of course, are companies that they are pretty old. They've been around for many years, like Unilever, been around for many years. So, and you're sitting around waiting for some kind of dividend. They're not going to grow any much, growing a little bit, just pure population. There's no much, they're maturing, I guess. So those are the income companies. And some people love income companies, especially in a recession where technology companies get affected more than income companies. And then you have the value investing, which is the combination of the two, like a Microsoft that pays dividends, but also there's some growth. But everything is balanced, right? You won't expect Microsoft to grow as fast as some of the other technology companies, but it is a technology company too. But it's an old technology that they are reinventing themselves. And you can tell with AI now and everything else, Microsoft is again on the discussion table. Because before, Microsoft was one of those companies that they missed a lot of the growth that Apple's seen and few others. So it is a value stock and maybe more growth these days, given the whole AI explosion and discussion of the ChatGPT and everything else. So those are the growth companies or growth stocks. The value companies and value stocks I talked about. Income companies and income stocks. Defensive companies and stocks are companies that they do well in the recession, like food, grocery companies, healthcare providers. Those are the companies they're all going to do okay in recession. They're more defensive. Defensive, when I say defensive, I don't mean the military. I'm talking about defensive against a sudden recession. People are always going to buy bread. They're always going to buy milk. And those are the defensive type companies, the non-discretionary type items, for example, healthcare that you need. Cyclical companies are the companies that they do really well in the economic expansion, and they are doing really bad in a recession. And those are the big items like the auto. Buying cars, of course, is very expensive. They do well in an expansion as people have jobs. They can afford to buy cars. But then when you have unemployment, people are going to hold on to their own cars, so they won't buy new cars. Appliances, another one. So those are kind of a very large economic type decisions you have to make as a family in a recession or versus non-recession. Speculative companies are speculation. They're more startups like Uber, like WeWork, those companies, DoorDash. So DoorDash is doing okay, but they have other issues. So it's speculative companies. It's companies that you think that technology is going to be there and people will use it, even though they're not using it yet. So, and those are speculation. Of course, Amazon was a speculative company for many years, and now it's a more established company because people use Amazon to buy stuff. Amazon is one of those companies that waited 14 years to disrupt the market, how you buy stuff. And whoever bought Amazon 20 years ago, they are doing very well now. So that's the disruptive, and that's the speculation of the next generation technology, okay? Especially a lot of speculation on AI companies. So you got to choose the right ones as the competing who is going to be the leader. So those are more speculation type companies. Let's look at technical analysis. There's some concepts of technical analysis. The technical analysis, there are more than four, but four traditional analysis that Wall Street uses. The one is called the trend line analysis. The trend line analysis, basically, they look in the upper and lower. See, this stock is going up, but it has an upper and lower threshold, like a standard deviation. So basically, think about it. A machine, like a computer, will buy when it hits that, that decline here, and then it will sell it when it hits the line up here. They will buy here, will sell it up here, buy here, sell here, and then from here they can predict what is the company going to do. If it hits the line, probably it's going down before it goes up. So it's a lot of that analysis the computer does in predicting the stock movement in the next, next interval. Another one is called the price channel. They look at so trend line is looking at the actual stock price. You see, this is stock price here, 0 to 80. Price channel looks like the percentage change. So they have the resistance level and then the support level. What support level? Let's say 10%. Like, look at Bitcoin now. Bitcoin has been trading between 26,000 and 30,000 for a long time. So I would call it Bitcoin at around 25, 26,000. That will be a support level. And then the resistance level is about 30. I haven't seen Bitcoin more than 30,000 in a long time. So if I was a technical guy, I will be buying Bitcoin at 26 and selling at 30. Buying at 26, sell at 30, you make money in the process, right? And that's kind of the price channel analysis that people do. Another one is called the average line analysis, very basic. If it trades below the average, you buy. If it trades above the average, you sell, even though the average is moving at the upper direction. And that's the average line analysis. And this one was discovered by this guy, Cliff Asness from AQR. It's called momentum indicator. Basically, when the stocks go up, they continue to go up on momentum because it's almost like fear of missing out. People talk to each other. Man, you got to buy that new lemon. It's going up and everyone's jumping on it. And it has momentum and it's in the news and the media. So it's continue going up by this guy talking about it, even though it went higher than what the expectation is, because it went higher because they had very good numbers, for example. So once the news are out, you know how they say buy on the rumors and sell on the news? It's the same concept. The rumor will bring the stock up. And when the news are out, because we already know the news as a rumor, then that's when you sell, right? But there's momentum. It continues going up as people talking more about it and actually bragging about it, that I bought it and you should buy too. And so you're moving on the way up. The same thing when it's going down, it goes down quick because the negative news that they distribute it really quick through the media and people try to sell it quicker. So this is the momentum indicator. And if you go on Bloomberg, they have a momentum indicator for each company that shows. And it's basically this formula here. They look at the stock prices at different changes, at either at at different levels of momentum. Okay. Behavior, of course, is it's another reason stock go up and down. And what I did, actually, I love this book. This is 1936, by the way, this book. 1936, a famous economist, which you guys hear all the time, Keynesian. So Keynes and Keynesian economy wrote this book about the general theory of employment and interest and money. It's basically how the economy works. And basically, the federal government uses many tools from that. And you can see yesterday or 2 days ago, the Fed kept the rates the same because they use the tools in managing inflation by increasing or decreasing the interest rate, the risk-free rate. So there are many principles how to manage the economy from the Keynesian book. But surprisingly, even though Keynesian is more like very technical guy, he looks like inflation, unemployment, between the labor market, the inflation on goods, the inflation on the labor market, and the interest rate used as a tool to control the way the economy is going to work. Even though he's very traditionalist, it has a section there, which I love, on page 161 of this book. He wrote this beautiful written, this is way back in 36, and he says, even apart from the instability due to speculation, people speculate all the time, there is the instability due to the characteristics of human nature that at a large proportion of our positive activities depend on spontaneous optimism rather than mathematical expectations. So basically, he says that people make rash decisions. They want to sell. It doesn't matter if it's not good time to sell or when it's a good time to buy. There is this human nature of us, this gambling ability, this gambling momentum, gambling that you move the stocks ourselves. In other words, whatever the will of the nature of the natural progression of the humans, you can make decisions. And he called it the animal spirits. And this word animal spirits actually hit every textbook after, especially behavioral finance. It is our animal spirit, is our gambling mentality that we want to be in the stock market that sometimes drives the stock up and down. And within the behavioral, and there's a huge field in behavioral economy, behavioral finance, is there some other concepts that they were written. I've said one of them that is not here is called the FOMO, fear of missing out. Remember the whole euphoria of Bitcoin? Everyone will buy Bitcoin. Everybody's setting up small accounts because from a 1 penny company, Bitcoin went to 60,000. So everyone has to make money. And this fear of missing out, you buy because your friends bought. It's a very behavioral activity, right? But some more traditional behavioral concepts is called forecasting errors. We as nature, we want to prove our boss wrong. So we actually build the narrative of a stock. So we are building our forecast so it can meet what the expectation is, even though the expectation should drive the forecast. So basically, this has many errors in the analysis, so many, but because everybody's doing it, it affects the stock price, right? Another one is overconfidence. So many people talk about stocks like crazy. I turn to CNBC and they're promoting left and right of stocks. So the overconfidence will push the stock up because everyone's confident. And that's a very behavioral thing. They don't look at fundamentals, why the stock should go up or something. Also, conservatism. When the stock goes down, you sell it. You be conservative. I don't want to lose any more money, even though the company might be okay. It went down for many reasons that they're going to get fixed anyway. Is this conservatism too can also play a big role in how stocks move. The other one is called framing. You always frame the content. You're always trying to find positives or negatives on the stock. and you ignore, if you're a positive person, you're going to ignore any negatives. And if you're a negative person, you ignore any positives to make your story. So you're framing your narrative to buy the stock, and you try to convince your boss or someone else to buy it because of those issues. And of course, you have to look at both the risks and the rewards when you are looking at the companies. Or if you look at the risk and rewards to be objective, you become subjective because you put more weight on the positives and less weight on the negatives. Okay. The other one is called mental accounting. Mental accounting is when you are managing other people's money versus managing your own money. When you manage other people's money, believe it or not, you are a little more conservative. Why? Because if you manage other people's money, your job is at stake. If you messed up, you might lose your job, right? But if you manage your own money and nobody knows, and I take chances and it's messed up, you're not going to tell anyone, it's fine. But when you're out there, try to get paid bonuses and work, and you manage other people's money, you try to be more conservative, which is actually sometimes too conservative is not good for your investor, right? The investor wants to take some chances. So mental accounting is a big behavioral, because there's other reasons why you are, you're doing what you're doing, instead of looking at taking the highest risk, the lowest risk possible to the highest type of return. Regret avoidance, that's another behavioral concept in finance. It's easy to lose money on Apple. If I bought Apple stock and it goes down, it is an easier discussion with your client. Yeah, I bought Apple like everyone else and it went down. And you say, okay, no problem. Than saying, I went and bought this company, this company that makes artificial tomatoes or something. And then you have to explain, why did you do that again? And if it goes down. So it's sometimes because of that, a portfolio manager will go to the traditional purchases because it's easier to have discussion when things are not going well. Okay. So we have another maybe 20 minutes to discuss valuation. I wanted to discuss very basic, though I'm going to have a whole section of that, and I'll leave about 10 minutes for question and answers. So when you value the stock, as I mentioned, on a pure basis, you have technical things are moving up and down, you have fundamentals, you have behavioral, but in general, there's some guidance what the stock fair price of the stock should be. And those guidance, they are valuation methods. And so I picked up 8 type of methods of valuing the equity or the stock of the company. The first, I want to call it the first 3 methods. They are more technical and market methods. Method 4, 5, 6, and 7, they are more fundamental methods. And then 8 is very specific option. That's for stocks that are doing well. So let's go through all those. The method 1, of course, is looking at the enterprise value of the company. Okay, what is the value of the company, basically? The value of the firm. And how do you calculate enterprise value? Of course, enterprise value is the market value of the equity. The equity being the stock. If you take all the shares of the company, which is here, multiplied by the stock price. So all the shares the company issue out there. Let's say Hyatt Hotel has 179 million shares that they issue and people have them out there. My grandmother has 10 shares in Florida. She is part of those 179 million shares. If you take all the shares times the stock price, you will get to the market value of the equity. And then I add the debt the company that they only report every 3 months. If I take the debt amount minus the cash amount, meaning net debt, then you get to an enterprise value. The reason I bring enterprise value because a lot of the methods, they calculate enterprise value first, and then you reverse the process to get to the stock price, okay? So method one is basically using the stock market, using the stock price, because the stock price itself, it is the value of the company, what people are willing to pay for the stock. So if I look at Hyatt as my example here, and this is a little old anyway, but I'll make it sure. Hyatt at that time was trading at $76 a share on that day, times 102 million shares outstanding. It puts the market value of the equity, sometimes they call it market cap, of 7.7 billion. If I add the debt, and the debt is the last reported, which is 2 months before, right? It puts the debt at 1.6, subtract cash, you get to an enterprise value. So now we are method 2, 3, 4, 5, 6, 7. We are in a position to challenge that 8.4 billion equity value, because 8.4 is what is trading. So all the other methods that Wall Street runs is to challenge, is the fair value of Hyatt at 76? Is it a recommendation to buy at 76, sell at 76, or hold? Well, let's try different methods to do that. And I'm going to go quickly on this. Method 2 is called the intrinsic value. And the intrinsic value, you're looking at, and this is the right here, you're looking at the dividend the company is going to pay a year from now. You look at the price of the stock a year from now. How do you get that? Well, that's the stock that most analysts have as a target. So let's say Hyatt, which I'm going to see in a few minutes, has a target of $90 by most analysts. So I'm going to put the 90 here, plus any dividends the company is going to pay. So that's the future value of the stock. That's why it's called intrinsic. But then I have to discount back based on expectation, which is the K. K is an interest rate expectation. So every company out there has an expectation of growth. Tesla, for example, is expected to grow 20% a year. Microsoft is expected to grow only 8% a year. So there is some expectation. Doesn't mean they're going to hit it. So if I have the expectation, K, and I bring back the future price back in today's dollars, then it would determine what the stock should be trading at. The K, though, is calculated by this using the so-called CAPM, the capital asset pricing model, which we talked about as a quant, and we're going to discuss a lot in one of the sessions. It's basically taking the risk-free rate plus the expectation of the market times some kind of factor of beta. And beta is more like a factor of if you have a view of the market. If you have the view of the market that is going to go up 10% next year and you want to buy Tesla stock, well, Tesla has a beta of 2. So if the market is going up 10%, then Tesla should go up 20%. Also, if the market goes down 10%, then Tesla should go down 20%. So you use the beta, which is a historical basis, to come up with the expectation of the company. You take the E, you put it in the K here, and then you go back. So let's look at an example. Hyatt Hotels, most analysts say the stock is going to be $90 a year from now. Remember, it's 76 now. I take the 90 plus the stock, the company is going to pay dividends. So 90 plus 0.76 divided by 1 plus some kind of an expectation. I calculate the expectation for Hyatt is 11.5%. That means if I take the risk-free rate at the time when I did the deal, when I looked at the company, it was 1.5. Hyatt had a 1.1 beta, which means it's going to grow faster by the market by 10%, 11%. The premium of the market is 9%. And so if I do the calculation here, I come up with 11.5%. Now, if I take this formula, 76 on the numerator, plus 90 divided by 1 plus 11.5%, is suggesting the stock should be at $81 today. It is 76 now. So 81 looks like maybe I should be buying at 76. So that's the second method. Method 3 is called the dividend discount model. It's not the best method by far. It works when the company pays dividends. You put the dividend, the 76 cents mentioned, divided by the expectation adjusted for growth. So that's minus G. It is actually, it's not a good method for you don't use that method if the company doesn't pay dividends. So this is purely you buy the company based on the dividends. And if I do that for Hyatt, it puts this company at $73. And I'm going to have a table later show you everything. Method 4 is more fundamental. You look at Hyatt hotels down here as compared to other hotels. So you use the same method 1. You look at the stock price of each hotel, their peers or the competitors. You multiply to get to an equity value. You add the debt minus cash. You get the enterprise value. And then you take their profit of the company before taxes. You take that divided by that to come up with what is a trading multiple. Because think about it, the profit is highly correlated with the value of the company. The higher the value, the higher the profit. But sometimes the value is much higher than the profit, that it gets away from the profit. Can you imagine you have a company with very huge value with a tiny profit? That multiple is high. So in generally speaking, high multiple companies, that means the value is growing faster than the profit. And they use that as a measurement of value. So if I do the average of all the hotels here, I get to a 14.69 times. Apply 14.69 times as the industry multiple times Hyatt's EBITDA. It puts the price of Hyatt at $77, which is pretty close to what it's trading now. So it's trading around industry levels, I guess. The next method is called the method 5. Method 5, of course, is it's companies that they were announced in the past how much somebody paid. You use this method in real estate. If you have to sell your apartment, how much will I sell it for? Well, the best method is to look at another apartment similar what somebody bought it for. The same thing with this. They look at other hotel company transactions. That's why it's called transaction multiple. For example, Hilton Hotels was bought by Blackstone at one point before it became public, and they paid about 14.7 times the EBITDA. Four Seasons were bought by the Saudi prince, and he put 32 times EBITDA because he paid about 3.5 billion, and the company reported 112 of EBITDA. So the multiple was 32 times. So I looked at 5 years of actual transactions, and the average around 13.19 times. I apply 13 as my multiple to Hyatt, and it puts the stock at $69. So 69, of course, is below the trading 76. So if I want to use just this method, I would recommend not a buy. And the last one, I guess, it's the DCF, though I'm not going to spend a lot of time now that I have a whole section. It's basically, this is when the analysts try to build projections for the company. What is the company going to do for the next 5 years? So they're building a whole projection to determine, based on these projections, called the DCF analysis, what the stock is going to be. And based on the projections, and I bet you that's what they use to get to the 90 target, it looks like they're projecting, if I do the projections, I get a $91 target, right? And then the leverage buyout method is basically looking from a private equity point of view. What is somebody's willing to pay for Hyatt to get the 25% return? It puts the stock at $84. So I put everything together. The stock is trading at 76. You use all the methods. Anything green is higher. So intrinsic value, which is the target, looks like that's a hold, because remember, you want to get about 10% higher. So that would be a buy recommendation, maybe a hold to buy. This is a sell recommendation because method 3 said the stock should be 72, but it's 76. This method is a hold to a buy, maybe hold because it's such a close. This method 5, it puts the stock at 69, so it's a sell. And then the last two analysis puts into a buy. 91 is a buy. 76 a buy because it suggests 91. And then 76 a buy because it suggests 84. So on an average, the stock should be around 79, it's 76. So it's pretty close what it's trading at. So those are the kind of valuations that show how the stock trades. We're going to go over this very more detail through the analysis in a later date about discussing specific valuations of public companies. And then I have another session about valuation of private companies, which we're going to use method 8, for example. Okay. So with that, let me bring up my table. So as I mentioned, there's a valuation, 2-week valuation of public-private companies here. December, don't miss that. That's a very exciting area. We're going to go through what we just did, but in a more slower pace. But this concludes my stock market discussion and how you pick stocks and the fundamental, behavioral, and technical, and some ideas about how the stock moves in an hour and a half. So if you have any questions, I'll stay online. Otherwise, thanks for listening, guys. And hopefully we'll see you, for me, to see you on November 18th. But please dial in next week to hear some of the other lectures on those subjects. Okay, thank you.
Hi, Professor. I have a quick question.
Yes.
So when I look your slide on the math, math of the EBITDA one, now I just wondering if there is any relationship between the EBITDA and the beta. If the EBITDA higher, the beta should be
beta, because beta is more like a growth concept, is a volatility concept. We're going to discuss beta beta coefficient in one of my classes, but beta is looking at the change of the stock versus the market. So if the company is growing the EBITDA, so EBITDA by itself doesn't mean anything, but if you look at trend of EBITDA from a year before, few years, that should have some correlation to the beta, because high beta companies are high growth companies, therefore higher return expectation. So yes, the higher the value, the higher the growth of EBITDA, the change of EBITDA from one year to the next, not the actual EBITDA. And the multiples of EBITDA, it is also a function of growth, right? In general, the high multiple EBITDA companies, those are the high growth companies, because the anticipation that the company's EBITDA next year is going to be up, then it puts in general the high multiple of those companies. So high multiple EBITDA are more technology companies. Low EBITDA multiples are more like utilities, more like kind of straight companies. So there is all related, right? In terms of the change. Yeah.
Thank you. Yeah, because I saw for the Mario, it has really high, big number of multiple EBITDA, and it also has a really a large number on the beta as well. Yeah,
because that one, Mario is the largest company in the world now. But Starwood, so people anticipate the economy is about 20 times. Actually, now it's trading even higher than that. So everybody loves the company. They are the drivers. They're global. So that's why they tend to pay more. So the value is higher than the EBITDA can catch up with them. Okay. And that's what the multiple is. Yeah.
By the way, which one is the one, you say the value it's more than the profit? It's EBITDA or EBITDA multiple?
Well, if you think about it, EBITDA multiple is enterprise value numerator, EBITDA denominator. So sometimes the value gets away from the profit. So let's say that the stock, people buy the stock and a stock is going up, but they haven't really reported any EBITDA yet. So for a moment, it's a high multiple, it's the anticipation. So sometimes I tell people, when you have a high multiple, especially more than the rest of the industry, you might get disappointed if they announce the EBITDA and is lower than you think, then the stock is going to drop, right? So sometimes the value goes ahead because the value it trades every day, where the EBITDA is only announced every 3 months, right? So
Okay.
that's why I'm saying people anticipate that the next reporting, the EBITDA is going to go up, so they buy in today. But by definition, if everybody buys today, the value is going to go up. And now they're hopefully the EBITDA comes true 3 months from now, so the multiple goes back to more normal, right? And that's the key.
Okay.
Yeah.
Okay. Thank you.
Thank
Thank you
you.
very much. Have a
Thank
great day.
Thank you. Any other questions, guys? Okay. There are no other questions. Thank you for listening. I'm glad to see as many of you here. Hopefully see you guys next week and many weeks to come. Okay. Again, thank you again. And see you soon. Thank you.
Professor,
Yes.
do you teach any other class in Colombia?
No, I only teach